Ricken Financial presents Kickin' with the Rickens, Redefining Retirement. Jerry Ricken and Heidi Ricken Provost want to help you reach the retirement you deserve. Let's build a strategy that gives you the confidence while meeting your financial wants and needs. Meet the team at rickenfinancial.com. Now, Kickin' with the Rickens.
RickenFinancial.com presents Kickin' with the Rickens, Redefining Retirement. Thanks for subscribing to our podcast here. My name is Mark Owens. Heidi Ricken Provost is here. Jerry Ricken is here. It is so good for the Three Musketeers to be back together again.
Hooray,
oh my
baby.
gosh,
Hooray.
the three best friends that
anyone could have, because we're the three best friends because as we've documented over the past couple of weeks, Jerry and his detached retina finally back in the game.
Back in the saddle, baby.
Heidi,
How dare Jerry leave us hanging?
Unacceptable. But when Jerry comes back, Heidi, is he just guns blazing like, what do I need to do? What's been done? What's not been done?
Within an hour of the doctor telling him he could stand up straight, he was in the office. And I'm like, Dad, for the love of God.
Well,
it was so funny to me. He was like, doing nothing is not relaxing. I need to be here and do something. And he was, day one, he was beat. And I had to be like, you need to go home and take a nap. And he's like, I hate naps. I don't take naps. And then he went home and I found him an hour later, like passed out on their couch.
I didn't know. I'd fallen asleep.
Yeah.
A power nap solves everything.
Oh, yeah.
I just don't do those.
Are you still like looking through like Jello? Is that how you said it?
Yes,
Like
I am.
clear Jello
Yes,
on
I
the
am.
left eye?
Yeah. I've still got a little bit of that, but eventually that air bubble will go away. Everybody's told me I've been a half a bubble off my entire life. So
when the air bubble goes away, how does that happen? Like you've got an air bubble floating around your eye. Do they have to pop it or like I don't know?
No, apparently it just
isn't it like some sort of gas or something that just
it's
just
a gas.
dissipates or whatever? Yeah.
I'm still wearing my little bracelet.
Right.
Mark. And
it's not I've fallen and I can't get up. It's I have a gas bubble in my eye.
Gas bubble in eye. It's like, here it is. Gas bubble in eye. Here I am.
In my eye.
It's like if the house catches on fire, there are pets inside this house. If I fall down, there's a gas bubble. Please tell me, like, out of nowhere, you're going to be in a new client meeting one day and your gas bubble is just going to pop and it's going to be like, so anyway, oh, sorry.
I can at least blame it on the gas bubble.
That's my eye fart. Sorry about that. Well, you and your gas bubble. It's good to have you guys back. I'm glad to see the trio back together here on Kickin' with the Rickens. You can meet the team at rickenfinancial.com. Get more information in the show notes. And Heidi, recently throughout the year, the team at Ricken Financial, you'll hold great seminars, educational, complimentary seminars. You can always get more information, rickenfinancial.com. You had one not too long ago. So let's pick the brain. Let's get the temperature of the families that you serve and of the community. What's on their mind? What kind of questions were they asking you at the most recent seminar?
Well, I think everyone kind of has taxes at the top of their mind, just like we do, because we just made it through a tax season. And, when you have to cut those checks to the IRS and to whatever state you're in or whatever local municipality, it gets you thinking, how do I save taxes in the future? So,
well, at least it should get you thinking, how do you save taxes in the future?
Well,
but a lot of people don't focus on that.
Right. Well, you're right, because a lot of people think they want to save taxes today. But we actually had a lot of great questions about, first of all, what kind of taxes are going to be hitting them in the future, and how do I save on my taxes moving forward so I'm only paying my fair share, but nothing beyond that.
Mm-hmm.
Most surprising question I had, quite a few people in the audience, in fact, 80% of our audience did not know what a required minimum distribution was. But we also did have younger people in the crowd than...
Why do you think that is? I thought an RMD is something that as you edge towards retirement, it just becomes part of the nomenclature. It's like part of the conversation.
See, and I think because I live in this world on a daily basis, I think that a lot of people have a lot of common knowledge that we don't even understand that they don't have.
Yeah.
One thing I've realized when it comes to taxes, especially, the general public does not know much about taxation. So sometimes I feel like, okay, I do need to bring it back to basics. So if you're listening right now and you have no clue what a required minimum distribution is or how it might affect you in the future.
Heidi, what's a required minimum distribution?
And how is it going to affect me in the future?
Oh, yes, it is. Heidi, what's a required minimum distribution?
An RMD, a required minimum distribution, is an amount that the IRS forces you to take out of your traditional retirement funds, so your 401ks, IRAs, after a certain age. If you don't know what it is, you're probably born after 1960. So by age 75, you will take that amount out of your traditional funds.
And how's that calculated, Heidi?
It's calculated on a life expectancy scale by the IRS. And in the first year that you take it, you take about 3.78% out, or somewhere around 4% is what you're required to withdraw from those traditional accounts. And that amount increases each year as your life expectancy decreases.
And interestingly enough, when you get to age 100, they still say you're going to live for 2 more years.
Yep.
And 101, 2 more years, and 102, 2 more years. So they want you to take half of it out.
Why?
Yes.
Why do they force you to take your money out? Like, what's the benefit for them? What's the benefit for us?
The benefit for us over these working years is we did not have to pay tax on it.
But the benefit for the government is they want to collect taxes, Mark. Yeah. So it's a required amount that you have to take out so they can recoup some of the tax that you've deferred and deferred and deferred. Not only have you deferred on your principal, but you've deferred taxes on all of your earnings for all these years. So it was a ploy for the government to increase all of our accounts and increase the tax on all of our accounts so that they were in control of when you take it out and how much tax you pay in the future. So in some respects, people said, oh my gosh, this is going to be the greatest thing in the world. These 401ks, these IRAs, we're going to contribute. We're going to save taxes now when we're in our 20s and 30s and 40s and 50s, but not knowing that that's going to bite us when we're in our 70s, 80s, 90s.
We were all duped.
Okay.
We are.
What advice do you give to adults that are 50, 55, 60 years old, preparing for retirement? They're in that red zone of retirement, that 5 years out. What can they do now to prepare for RMDs, or is there anything?
They're going to run a tax map with us so we can figure out what their taxation looks like in the future. And we're going to see if there's any way that we can reduce those future taxes. So especially people, if they're after 65 and we're looking at it, they'll say, Heidi, Jerry, I don't think a Roth conversion makes sense, which would be taking the funds that are in traditional form right now, converting them into a Roth form and paying the tax today. Because they'll say, oh, that's going to increase my IRMA, Jerry. What's IRMA?
IRMA is your Medicare premiums. Medicare premiums are based on your earnings each year. So if you're over 65, you're on Medicare, your premiums that you pay the government, and sometimes it comes out of your Social Security check if you're on Social Security, those will increase with the amount of earnings you have that you're reporting on your 1040. People say, oh my gosh, I don't want to do that because it's going to increase that for the years in which I'm converting. Well, we run a tax map that Heidi was talking about earlier, and we can show you that with certainty, if you wait until 75, then you start taking the required amount out that the government says you must take out, your IRMA taxes or your Medicare premiums are going to go up each and every year in retirement, not just for a few years when you're making Roth conversions. So a lot of people miss that. And then they say, well, why would I pay that much tax now? Why don't I just pay the tax in the future? We can show you with certainty that the amount that your family is going to be paying in taxes now is much less than the amount that your family is going to be paying the IRS throughout your retirement lifetime.
Especially if you're 50, like you mentioned, Mark. I mean, you have plenty of time to get there.
Yeah.
But if you think about that, if you had 25 years of compounded growth that you're not paying taxes on until 25 years from now, you're going to make a big tax mistake by not taking advantage of moving some of that to Roth today.
Yeah.
And Heidi mentioned the fact that, when you're 78 years old, let's just pick on that, and you're paying about 4%, or you have to take about 4% of your earnings out in a required minimum distribution. Let's say you made 10% that year. Okay. So you didn't take that 6% out. Well, that 6% is compounding. And the next year you have to take more than 4% out. So the amount you have to take out is going to increase and increase and increase and increase each and every year, as long as your earnings are greater than the amount you're required to take out.
You said earlier, Heidi, that taxes are something that it's frustrating, but it's eye-opening how much that we not in the industry, that we don't know.
And to piggyback on that, Mark, it is the onus of the taxpayer to make sure that you take the proper amount of your required minimum distribution out each year. If you do not, you are subject to a 25% excise tax from the IRS. So what that means,
you get taxed on your tax?
Say your required minimum distribution is supposed to be $10,000. If you don't take that out, not only did you not have the income coming in, you have to pay a 25% tax on that. So $2,500 penalty for not drawing
taking the money.
your income.
So you get taxed for not taking your own money.
Yes.
Correct.
So you always have to make sure you know what your required minimum distribution should be and that you're taking it, because in the end, the onus is on you as the taxpayer, not on whoever's housing those funds, the custodian of them, who's managing them, not on the tax preparer. It's on you as taxpayer to make sure you have your bases covered.
A lot of layers to an RMD. RickenFinancial.com to continue this conversation. You also mentioned off the air that a lot of spouses didn't realize that in the event that someone in the relationship in the marriage passes away, your taxes are not going away, or your taxes in some instances may actually go up.
Talked about this when we were talking about women too, that we really need to, since women outlive men, statistically, we always do a little bit of additional tax planning when we're looking at a couple to make sure that when one member of the couple goes away, that your taxes are still going to be handled okay, because it is a common misconception. A lot of people think, okay, well, if my spouse goes away, then half of our income goes away. Well, that's only the case if your only income is Social Security.
And both of you are making the same amount of Social Security.
Exactly. So the higher of the two benefits from Social Security will live on with whoever is continuing to live on in the future. Your income's probably not going to dramatically change, other than having the lower of the two Social Security benefits pass away with your spouse. What does change are the deductions that you're eligible for. And there are so many nuances in the tax code that are based upon your income or your provisional income, which is how we tax Social Security. And all of those nuances, those numbers change when we go from married filing jointly to single. So it's very tax advantageous when you lose your partner, unfortunately.
Yeah.
Disadvantageous, right?
Yes.
Thank you. Disadvantageous.
There's more taxes when someone passes away.
Correct.
Thank you for saying that in English.
See,
please, thank you.
This is why it's good to have the team back together. We got each other's back.
That's
we got
right.
each other's back on this one. Fascinating, though, that in this seminar, Heidi, is that everyone was so curious about their tax strategies. And you also mentioned that there's also a lot of layers to an inheritance when it comes to your taxes as well.
Of course, because we were talking about required minimum distributions. Those come in one of two ways. First of all, just in your traditional accounts that you've saved yourself in the future, you have to start taking your RMDs. Or if you inherit an IRA that is not a spousal IRA, so say, I'm a beneficiary of someone who is not my spouse of their IRA.
Like a parent.
Okay.
A parent, a grandparent, whatever the situation may be, a friend. If you inherit an IRA that is not coming from your spouse, then you have 10 years now to withdraw the funds from that IRA. And, some people call that an RMD now. You have to take at least a portion out of it. But by the end of year 10, you have to take 100% of that IRA out of IRA format and pay the tax on it when you inherit it. So we've had a couple people who have inherited their parents' IRAs lately who have been talking to us, and they say, we don't really need this income. And
we know we have to take it out in the next 10 years. So
and it's causing more tax because we're already in a higher tax bracket than mom and dad were. And now we have to add income to this. How do we do this so that mom and dad worked way too hard for the IRS to be their biggest beneficiary? So, Jerry, how do I do this so that the IRS doesn't become mom's biggest beneficiary when I inherit this?
What we do is we do that tax mapping that we talked about. Okay. And we say, what's the most efficient way to take this money out of the IRA, pay tax on it, and then put it away for the future so we don't ever have tax in the future. And what we've been able to do is do that over maybe a 6, 7, 8 year period. Take the money out in equal payments, put that in to a tax advantaged life insurance program that will provide tax-free income in the future. So you're paying your tax now, is growing inside the life insurance policy, and life insurance is tax advantage more than any other financial instrument in the Internal Revenue Code. So we use it, and we buy the minimum amount of expense, which is death benefit. So we buy the minimum amount of expense. We put as much cash in there as we possibly can because we're after the cash value growth. at any point in the future, let's say you need that for an event. It's a wedding coming up. It's you're funding a grandkid's education, whatever it is. You can pull that money out tax-free and borrow it, and you never have to pay that debt back.
Right.
Because it's paid back out of the death benefit of the policy. So you take what was an IRA, convert it into a Roth equivalent that has a whole lot more flexibility than a Roth equivalent.
And the beautiful thing about this is you can create generational wealth now without taxes on it in the future.
That's exactly right. Because when you do pass and there is a death benefit, that death benefit passes on to your beneficiaries tax-free as well. So you can build generational wealth with the previous generation's wealth, if you will.
Right.
Yeah, without having to build additional tax, because a lot of the other ways that we take inheritances and we invest them creates more taxation in the future. So this is one way to reduce that taxation in the future for generations too.
RickenFinancial.com for more information. On a total side note, when it comes to these seminars that you do throughout the year, Heidi, what's your favorite part about this?
First of all, it's meeting people. I am the first. Okay, Mom, tune in. I am now publicly admitting I used to be mortified by my mom growing up because she would go anywhere and she would know these people's life stories within 3 minutes of meeting them. And I'm like, this is mortifying. Now I am her on steroids. And it is my that's my favorite part of this. I get to know and meet people that I haven't met before.
Right.
And you're not in the grocery store line.
Yeah, not in the grocery store line here. But first of all, we get to share education and help them. But second of all, I get to know them and they become a part of the fold, whether we work with them or not in the future. It's awesome getting to know people and hear their life experiences and, cool. Become Sheila in the real world.
That's so true.
What about you, Jerry?
True. Just in echoing what Heidi says, just getting to know people on a personal level, because we're in the people business. We aren't in the financial business. We're in the people business. We want to help people. We want to help see what makes you tick, what your interests are, what your concerns are, and see if we can help solve those and provide some value going forward. And if we can provide value, especially in the area of taxes, a lot of people just don't even focus on it. They think, we talked a little bit about inheritance tax earlier, and people think about estate taxes or death taxes. That's not what we're talking about. We're talking about income taxes that occur when you pass. And if we can mitigate those, it makes your beneficiaries, and not the IRS.
Not your government. I love what you said earlier. Uncle Sam doesn't deserve your inheritance. Family does.
Exactly.
Absolutely.
RickenFinancial.com to meet the team. You could schedule that no cost, no obligation consultation from the homepage. You could also see all the services they have to offer. Again, RickenFinancial.com. You can get more information here in the show notes. Well, I know you you have seminars scheduled throughout the year too, so you always keep those updated on the website, correct?
Absolutely.
Yes, perfect. Your opportunity to meet the team, also get some one-on-one Q&A and get some great information from one of the great seminars from the team at Ricken Financial. Well, before we get out of here, first and foremost, let me just say that, Heidi, it's so good to see you. It's so good to see you as well.
I appreciate that.
Absolutely.
I appreciate that. Yeah.
One-eyed Jack is back.
And you know what? It is great to see you, too.
There it is. There it is.
It's such a blessing to have my eyesight coming back.
Finish this up for me every day.
It's a holiday.
Life is short.
Laugh hard.
Appreciate you listening. This has been Kickin' with the Rickens, redefining retirement.
Insurance products are offered through the insurance business Ricken Financial, LLC. Ricken Financial, LLC is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Ricken Financial, LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Ricken Financial, LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Ricken Financial, LLC.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.